I'm joined now by Eugene Flood. He is president and CEO of fixed income manager Smith Breeden. He is also the chair of the investment committee at pension fund manager TIAA-CREF. And Gene is actually in town from North Carolina. Welcome to Bloomberg. Thank you for coming on to the program.
Thanks very much, Scarlet.
Now, of course, this week there's a lot of buzz over whether the Federal Reserve should be wading back into the market, buying treasuries, buying mortgage bonds, basically beefing up its balance sheet once again as it tries to guide the economy back to a more robust recovery. Do you think this is a good idea?
Yes, we do think it's a good idea at Smith Breeden. The way that this would likely be implemented, it's one of the three options that the Chairman Bernanke spoke about last week. And the way it would likely be implemented is that as the bonds mature in their current very large portfolio that's over $2 trillion, they would reinvest those maturing cash flows back into the bond market, into either treasuries or mortgage-backed securities. We think that that is a good idea, and the reason is this, is that anything that policymakers can do right now to stabilize the environment will help businesses make good decisions. Right now, corporations, as we hear from chief financial officers, tell us that the reason that they are concerned about making further investments, making further hiring decisions, is because uncertainty is just so high. Market uncertainty, direction of the economy, and then also policy and regulatory
So this provides some consistency.
Exactly, and that is something that's very important right now to allow businesses to move ahead and make rational, long-term, measured decisions.
If that's the case, I mean, recall when the Fed first got into the bond buying act here, everyone was saying that the Fed was really distorting things in the market. Now it seems like the markets can't function without the Fed playing a big role, or the government for that matter.
Well, it was important to have a lot of stimulus when the economy got in deep trouble. And that's normal, that the role of government programs should be to provide counter-cyclical measures. So when things get bad, government gets more active. When things are better, they can step back. And the hope certainly is that over time, they'll be able to step back.
Now, Europe is taking a very different tack with the ECB mulling ways of getting out, looking at an exit strategy. Is that more reassuring to have a government focused on fiscal discipline at that point?
It depends on where we are in the cycle, so that if there are still risks of a downturn, then what's most reassuring to the marketplace is to hear that the government is still there and ready to do more. If things are starting to heal and there's a lot of confidence around that healing, then the government can certainly start to talk about exit strategies.
Is there more confidence in the healing over in Europe?
Not from our perspective. I think from where we see growth in Europe being on the order of 1.5% to 2%, we actually see growth in the U.S. being more like on the order of 2.5%. So we think our economy is actually stronger than the Eurozone.
Okay, so they're taking the wrong approach in your mind.
I think they're talking about that a little too early.